Ladies and gentlemen, I'm about to say something that will irritate a lot of silver holders. It will rub against everything you've been told in forums, comment sections, and late-night conversations about real money. Some of you will instinctively want to push back before I even finish the sentence. And that reaction alone is exactly why this needs to be said. Here it is, plain and uncomfortable. Treating silver like an investment instead of insurance is quietly limiting your financial growth, not destroying it overnight, not wiping you out in a dramatic collapse, just slowly, silently capping how far you can ever go. Now, let me be clear. This isn't an attack on intelligence. It's not a criticism of discipline or foresight. In fact, most people who stack silver are thoughtful, cautious, and serious about their future. The problem isn't ignorance. The problem is strategy, a subtle but critical misunderstanding about what silver is designed to do and what it is not. What is happening is this. People are playing defense before they've built anything worth defending. They're protecting capital that hasn't had the chance to grow. They're ensuring a future that never fully materializes. And because the mistake feels responsible, it often goes unnoticed for years, sometimes decades. This video is going to separate two ideas that most people wrongly blend together: growth versus protection, offense versus defense, wealth building versus wealth preserving. Once you understand the difference, you'll see why silver excels at one role and quietly fails at the other. And if you follow closely, what you're about to hear won't just change how you think about silver. It will change how you think about risk, safety, and what actually creates financial freedom in the real world. Let's start with why people buy silver in the first place. Because these reasons are valid, and they deserve to be respected. People buy silver because they don't trust fiat currency. They see money being printed, debt piling up, and purchasing power quietly eroding year after year. Silver feels like an escape from that system, something real, something honest. They buy silver because it's tangible. You can hold it. You can store it. You don't need permission from a bank, a broker, or a government to own it. It exists outside the digital ledger, outside the system, and that matters to people who value sovereignty. They buy silver because they fear systemic collapse, bank failures, market crashes, currency resets, power outages. When things break, silver doesn't disappear. It doesn't depend on servers, electricity, or counterparties. It's there when everything else isn't. They buy silver to eliminate counterparty risk. No middlemen, no promises, no IOUs. If it's in your possession, it's yours. That certainty is rare in modern finance, and it's deeply appealing. And many people buy silver because they want financial independence and preparedness. They don't want to be caught off guard. They want to be ready for inflation, for instability, for uncertainty. I understand that, truly. The logic makes sense. Silver does have value. Silver does have a purpose. This isn't an anti-silver argument, it's an anti-confusion argument. Because here's the critical distinction that almost no one explains clearly enough. Silver preserves wealth. Investments grow wealth. Those are not the same thing. Preservation is about keeping what you already have. Growth is about creating more. And preservation without prior growth is ineffective. You can't protect abundance if abundance was never built in the first place. Silver doesn't multiply. It doesn't work for you. It doesn't wake up every day trying to produce more value on your behalf. You can store it, you can secure it, you can defend it. But after 10 years, 20 years, or 30 years, you still have the same metal you started with. The value may fluctuate, but the asset itself is static. Holding silver freezes value. It does not expand it. And when you rely on preservation before you've achieved growth, what you're really doing is playing defense before you've built anything worth defending. Let's make this painfully simple. Imagine you take $10,000 and put it into silver. You buy the bars, lock them away, and walk off feeling secure. 10 years pass, 20 years pass, 30 years pass. How much silver do you have? The same amount you started with. If you bought 300 ounces, you still have 300 ounces. The metal didn't increase. It didn't add to itself. It didn't create anything new. The only thing that changed was the price tag someone else might be willing to pay for it. Best case scenario, the price goes up and your purchasing power is preserved. Worst case scenario, it goes sideways or down and you're stuck waiting, sometimes for decades. But either way, the quantity never grows. The asset itself never expands. Now contrast that with a productive asset. Take that same $10,000 and place it into something that generates income, stocks, businesses, or income-producing real estate. That money doesn't just sit there. It moves, it earns, it produces cash flow. And that cash flow doesn't get spent. It gets reinvested. Those reinvestments generate more income. That income buys more assets. Those assets generate even more income. That's compounding. And compounding isn't exciting year to year. It's devastatingly powerful over time. Here's the part most people miss. The real cost of silver isn't that it might go down. The real cost is what it fails to become. While one pile of money stays frozen, the other quietly multiplies. The gap between them widens every single year, even if silver does fine. That gap is opportunity cost. An opportunity cost doesn't feel like loss in the moment. It feels safe, it feels responsible, it feels conservative. But decades later, it shows up as a life that could have been larger and wasn't. This is why productive assets matter. A productive asset does three things. It generates income, that income compounds, and the compounding reinvests itself. It's a system that feeds on its own output. Think of it this way. Productive assets reproduce. Silver does not. Silver is static. It waits. It relies on external price movement to matter. Productive assets create value internally. They don't need a crisis or a spike to work. They work by design. Real financial growth doesn't come from hoping an asset becomes more expensive. It comes from owning systems that generate more capital over time, whether prices go up or not. Now, this is where the pushback usually starts. Silver advocates will say, but what about inflation? What about market crashes? What about 2008, 2020, or the next collapse no one sees coming? And they're not wrong to ask those questions. Yes, markets are volatile. Stocks fall, bear markets happen, crashes are real, and they can be violent. Anyone who tells you otherwise either hasn't either been paying attention or hasn't been invested long enough. Inflation is real too. Currency loses purchasing power. Entire financial systems have failed throughout history. These are legitimate risks, not imaginary fears. But here's what's often misunderstood. Volatility is not the same thing as failure. Productive systems bend, but they don't break. Markets crash, and then they recover. Recessions come, and then expansion follows. Every major market collapse in modern history has been followed by a new high over time, not because markets are magical, but because the underlying businesses adapt, innovate, cut costs, find new demand, and keep producing value. That's the difference. A crash is temporary. A lost decade of compounding is permanent. When markets fall, productive assets don't stop existing. They continue generating income. Dividends keep getting paid. Businesses keep operating. And for long-term owners, those downturns often accelerate future gains because reinvestments happen at lower prices. Silver, on the other hand, doesn't recover in the same way. It doesn't innovate, it doesn't increase output, it doesn't pay you while you wait. If you buy at the wrong time, you can spend years or decades just getting back to even. And even when silver performs well during moments of crisis, those moments are brief. You're betting your financial future on rare events instead of consistent systems. That's the trade-off. Crashes hurt emotionally. They feel dangerous in the moment. But missing years of compounding quietly reshapes your entire future. And you don't have to feel that loss until it's too late to get the time back. Whenever silver is defended, the same historical example eventually comes up, the 1970s. And to be fair, it's a powerful example. Inflation was high. The dollar was under pressure. Confidence in institutions was collapsing, and silver exploded from just over $1 to nearly 50. On paper, it was a once-in-a-lifetime run. People who held silver during that exact window did extremely well, but here's the part that gets quietly skipped. That period was an exception, not a model. It was a rare combination of stagflation, monetary upheaval, and policy failure that does not repeat on a predictable schedule. And immediately after that spike, silver collapsed, falling from $50 back down near $5. If you didn't sell near the top, most of those gains vanished. Worse than that, if you held silver long-term after that moment, you dramatically underperformed growth assets for decades. While businesses expanded, technology advanced, and capital compounded elsewhere, silver largely moved sideways in real terms. This is the danger of misused examples. Betting your financial future on rare crises is not a strategy. It's speculation. It's waiting for disorder instead of building order. It's hoping the system breaks in just the right way at just the right time so your asset finally shines. And hoping for collapse is not the same thing as building wealth. Over long periods, silver has repeatedly lagged behind productive assets. Not because it's useless, but because it's not designed to grow. It reacts to stress, it doesn't create progress. And this is where the core metaphor becomes unavoidable. Silver is insurance. You don't buy insurance to get rich. You don't measure your auto policy by how much profit it makes you. You don't open a homeowner's policy expecting it to outperform the stock market. You buy insurance so that if something goes wrong, you're protected. Silver works the same way. It protects against monetary failure, currency debasement, and systemic risk. That's valuable. That's important. And in some cases, it's necessary. But over-insuring doesn't make you safer. It makes you stagnant. You can be fully prepared and still never move forward. Prepared, but not prosperous. This is the strategic mistake most people never realize they're making. They treat silver like a retirement vehicle. They pour long-term capital into it as if time alone will do the work. They allocate 40, 50, sometimes 70% of their net worth to a defensive asset, and then wonder why nothing seems to move forward. What they've really done is overweight protection and underweight growth. And when defense dominates the strategy, Stagnation is guaranteed. Not occasionally, not temporarily, structurally. Because the asset they're relying on is designed to hold, not to build. Years pass, the account feels safe, but the future doesn't get bigger. Here's where the distinction matters. Wealthy people use silver very differently. When someone already has millions, allocating a small portion to silver makes sense. 10% of abundance as insurance is rational. It doesn't limit their lifestyle, their options, or their compounding engine. Their wealth is already working elsewhere. But when someone with $50,000 puts $40,000 into silver, they aren't being cautious. They're sabotaging their own growth. They've locked away the very capital that needed to be productive. They've protected themselves out of ever becoming wealthy. Same asset, same logic, completely different outcome, because strategy depends on where you are, not just what you believe. And this leads to the framework that actually works. Use silver the way insurance is meant to be used. Keep a small, intentional percentage of your net worth in it, enough to hedge against catastrophe, currency failure, or systemic risk. That's your safety net. That's your peace of mind. But the majority of your capital should be in assets that grow, assets that generate income, assets that compound over time and expand your future whether the world is calm or chaotic. This is balance. Prepare for the worst, but build for the best. Because wealth must come first, protection comes second. And here X, as the part most people never get to, because they never build the wealth required to see it. Once you've actually accumulated real assets, once your capital is producing income and compounding on its own, the role of silver changes. It stops being the centerpiece. It becomes what it was always meant to be, a quiet layer of protection in the background, not the engine in the foreground. At that point, owning silver doesn't feel like hope. It feels like insurance, calm, boring, intentional. The tragedy is that many people reverse the order. They protect first, grow later, and later never comes. Not because the world collapsed, but because time passed and nothing was allowed to work. This isn't about choosing silver or rejecting it. It's about sequence, about knowing when to defend and when to advance. And once you understand that difference, you start to realize that the real risk isn't volatility, inflation, or even collapse. It's spending your best years preparing for a future that never had the chance to grow.